Welcome back. Today we're standing at a crossroads where credit policies, government interests, and a sheer volume of money in the system are converging to create what I believe will be a structural bull market in real estate by 2026. Part 1. The death of the 30-year standard. For decades, the 30-year mortgage was the gold standard. It was the safe way to buy a home. But under the weight of high interest rates and soaring property values, that standard is fracturing. We are seeing a global trend toward hyperextended credit. In the United States, we're hearing radical proposals. During his campaign, Donald Trump suggested the introduction of 50-year mortgages to combat the affordability crisis. This isn't just political rhetoric. The director of the Federal Housing Finance Agency has publicly stated that such long-term loan schemes are worth pushing forward and could fundamentally rewrite market rules. But while the U.S. is debating it, Australia is already doing it. Since late 2024, the credit market here has shifted. Institutions like Pepper Money, Great Southern Bank, Australia Mutual Bank, and RACQ Bank have launched 40-year mortgage products. Currently, at least 7 major lenders are offering these ultra-long-term loans, specifically targeting young, first-time buyers who are otherwise priced out. Insight from outside the sources. This shift mirrors the evolution of the Japanese housing market in the 1980s or the current multi-generational loans in parts of Europe. When prices outpace wages, the only lever left to pull is time. By stretching the repayment period, banks are essentially turning mortgages into a form of perpetual rent with the hope of capital gains. Part 2. The math of certainty versus the math of interest. Let's look at the numbers because this is where most people get stuck. If you take an $800,000 loan at a 5.64% interest rate, a 30-year term requires a monthly payment of about $4,600, with total interest costs of $850,000. If you stretch that to 40 years, your monthly payment drops to $4,200. On paper, you save $400 a month in cash flow. But the trap, if you want to call it that, is that your total interest jumps to $1.2 million. You are paying an extra $350,000 for the privilege of lower monthly payments. Who would agree to this? According to recent surveys, nearly 1/3 of Gen Z and Millennials and 1/5 of Gen X are willing to take that deal. Why? Because they aren't looking for a perfect mathematical model. They're looking for certainty. 1. Certainty of capacity. A 40-year term increases a buyer's borrowing power by 8% to 10%. In a market like Sydney or Brisbane, that takes a budget from $1 million to $1.1 million, moving the buyer from a passive price taker to someone who can actually compete in high-growth areas. 2. Certainty of strategy. Here is the secret. Nobody actually keeps a 40-year loan for 40 years. The average holding period for a property in Australia is only 10.5 years. The 40-year loan is a Trojan horse to get into the market. Once the asset appreciates over a decade, owners either refinance or sell, using the capital growth to leapfrog into their next home. Part 3. The systemic removal of barriers. We have to ask, why is the government allowing and even encouraging this? On October 1st, the Australian government officially launched the First Home Guarantee Scheme, allowing buyers to enter with just a 5% deposit, with the government guaranteeing the rest. This removes the need for lenders' mortgage insurance. Now, think about the impact of that. LMI is usually a massive hurdle, often costing around $20,000 for high-leverage loans. By removing LMI and lowering deposit requirements, the entry barrier to the property market is being systematically dismantled. The underlying logic here is not to lower house prices. It is to sustain and stabilize them. In Australia, over 66% of federal MPs own at least one investment property. This creates a profound alignment of interests between policymakers and property owners. High property values also drive government revenue through land taxes and municipal rates. The system is designed to keep the asset reservoir full. Part 4. The silent engine. Global money supply. Now let's go deeper. If credit duration is the spark, then money supply is the fuel. To understand where we're going in 2026, we have to look at M1, M2, and M3, the measures of the total pool of money in the economy. During the pandemic, the Reserve Bank of Australia, known as RBA, printed hundreds of billions of dollars to support the economy. We saw a massive spike in M1 supply. While there was a brief contraction in 2022 when rates rose, the supply is growing again. As of early 2025, Australia's M2 money supply is growing at a rate of 5.3% year-on-year. Think of it like a children's ball pit. The more plastic balls you dump into the pit, the higher everyone floating on top of those balls will rise. Real estate is the ultimate float in this economy. When the growth of money outpaces the creation of goods and services, price inflation is the only possible outcome. This isn't just about the price of milk. It's about asset inflation. Historically, every time central banks have engaged in massive quantitative easing, also known as QE, whether after the GFC or during COVID, a massive, eye-watering surge in real estate prices followed in core cities with limited land. We are currently seeing the money supply in Australia rise from roughly $1.64 trillion to nearly $1.9 trillion. This is a silent dilution of your purchasing power. If you hold cash, you're losing. If you hold hard assets, like property, you're being lifted by the tide of new liquidity. Part 5. The 2026 Structural Bull Market. So what does this leave us? I believe that by 2026, we will enter a new phase of the global asset cycle. This won't be a temporary, speculative bubble. It will be a structural bull market, a fundamental repricing of what it costs to own land in a world of devaluing currency. The combination of ultra-long 40-year loans, government-backed low deposits, and a surging money supply is creating a perfect storm for price increases. The credit gates are opening. When people with the same income can suddenly borrow 10% more because of a 40-year term, and they no longer have to pay $20,000 in LMI, that increased buying power translates directly into upward pressure on prices, especially since supply cannot keep up. The divide is widening. We are seeing an acceleration of market bifurcation. Those who already own assets are using these new credit tools to amplify their advantage. Those who are waiting for a crash or for prices to become reasonable again are likely to be permanently locked out. In this environment, you aren't just investing in bricks and mortar. You are investing in a hedge against currency debasement. The hard asset is your shield. Final thoughts, the mindset shift. As we wrap up today's episode, I want to leave you with a thought. The real advantage in this market isn't just your capital, it's your mindset. If you view a 40-year mortgage as 40 years of debt, you are looking at it through an old lens. If you view it as a strategic entry tool to lock in an appreciating asset while the government prints more money to pay off the real value of that debt, you're playing the same game as the wealthiest investors. For those looking at investment properties, the interest-only model becomes even more effective in this high-inflation environment. If your rental yield covers the interest, and the property value doubles over time while the tenant covers the holding costs, you are accumulating wealth without ever needing to pay down the principal yourself. The window to get ahead of the 2026 surge is narrowing. Whether it's your first home or your next investment, proactive planning is the only way to cross the threshold before the gate closes. Analogy for understanding. Think of the global economy as a giant escalator. The escalator is moving upward via inflation. If you're standing on the floor, which means holding cash, the escalator is moving away from you. Taking on a long-term mortgage is like stepping onto that escalator. Even if you aren't climbing fast, the machine itself is carrying you to a higher floor. The 40-year mortgage is simply a longer, slower-moving step that makes it easier for you to get on the machine in the first place. Thank you for listening. If you found this analysis helpful, make sure to subscribe and share this with someone who needs to hear the truth about where the market is headed. We will see you next time.